So let's first look at stock trade selection. Now this is for a directional trade. So when we're going to enter a directional trade, we have a stock selection process we go through, and we like to use trend following. And if we use trend following, that allows us to follow the current price trend of a stock instead of trying to predict the future price movement. So we're trend followers. It's worked very well for many years. And if you use a trend following system, that eliminates emotional decision making and instead gives us the discipline we need to be successful traders. And our trade selection process, trend following trade selection process, works both in bull and bear markets. And during the 2002 and 2008 bear markets, we were heavily short equities and commodities and currencies. So the trend following works both ways, and we used it in 2002 and 2008 successfully when we were heavily short. So let's look at the two rules we use to select directional stock trades. The first rule is we want to determine the price trend of a stock using the 50 and 100-day EMA, exponential moving average. And then step two is we want to select a low-risk entry point using the Keltner channels. So we use the 50 and 100-day exponential moving average to determine the price trend. And if the 50-day exponential moving average is above the 100-day exponential moving average, then that stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. And as I mentioned, the trend following works in both bull and bear markets. And in bear markets, instead of buying stocks, we buy bearish ETFs. And here's an example of a buy signal with the 50 and 100-day EMA system. And this is a daily price chart for Starbucks. The red and black lines are the vertical lines are the daily price movement. And the blue line here is the 50-day EMA. The red line is the 100-day EMA. So we can see back in November, the blue line crossed above the red line, and Starbucks was on a buy signal. And as long as the 50-day EMA is above the 100-day EMA, then the stock remains on a buy signal. Here's an example of the sell signal for FXI, the Chinese stock ETF, and these red and black lines are the daily price movement. We can see right here that the 50-day EMA, the blue line, crossed below the 100-day EMA. So at that point, the FXI was on a sell signal, and as long as the 50-day is below the 100-day, then the FXI is on a sell signal. And you can download these, the 50 and 100-day EMA on stockcharts.com. Okay, and the second step in selecting a stock directional trade is to select a low-risk entry point using the Keltner channels. And the Keltner channels act as an overbought, oversold indicator. And when a stock is trading near the upper channel, it's becoming overbought, and it will normally retrace to the middle or lower channel. So what I did is I circled the points where the stock was trading near the upper channel and it was getting overbought, and you can see each time that it got overbought, it retraced, overbought, retraced, overbought, retraced. So when a stock is trading near the upper channel, it's getting overbought. When it's trading near the lower channel, it's getting oversold. So we can see that when it gets overbought, it normally retraces, and then when it gets oversold, it normally rallies. So we can see oversold rallies, oversold rallies, oversold rallies. So we use the Keltner channels to help us time our entry, and we don't want to buy when the stock is trading near the upper channel. We want to wait till it retraces towards the middle or lower channel. So we're going to look at a few trade examples, and we're going to show our actual brokerage transaction reports, and we'll circle the day on the chart that we bought the stock, and you can see that the Keltner channels allowed us to select low-risk entry points for our stock directional trades. So, and the thing to notice with these price charts is how the stocks rallied after we purchased them. So by using the Keltner channels, we were able to get a low-risk entry because the stocks didn't retrace much from our entry point. So here's one for the Vanguard Real Estate Investment Trust. We bought 600 shares of VNQ right in here, and you can see it had a pretty good rally after that. And we have an open trade. This is our stock portfolio here. We have an open trade profit in VNQ of $27,000. Here's another example. This is DVY. This is the dividend ETF. We bought 400 shares of DVY 8157 right in here. Now it did retrace a little bit right here, but you can see that it went on to new highs, so this allowed us to get a profitable entry buying it when it retraced towards the middle channel.
Chuck, we do have one other quick question, if you
yes.
don't mind. Anthony is asking, is the Keltner channel the same as the Bollinger Bands, and if not, how are they different?
Yes, the Keltner channels are very similar to the Bollinger Bands. The Keltner channels use the average true range, and I found them to be just a little more accurate for helping us enter trades than the Bollinger Bands. You could probably use both, but we just found over the years that the Keltner channels using the average true range are a little more accurate for our purposes of timing our entries. So you can see with DVY, the dividend ETF, we have a $18,000 open trade profit. Here's another example. This is for the XLU, the utilities ETF. We bought 1,000 shares at 46.26 right in here, and then it rallied up in over $50, and so with that, using those Keltner channels allowed us to get a low risk entry, and we have a $16,000 open trade profit on XLU. So the Keltner channels in these examples resulted in low risk entries as the stocks did not retrace much from our entry point, and this helped us from help prevent getting stopped out of our stock position.